If you are 40 or older, do you ever secretly worry that the decades of compound interest you missed back in your 20s have put your retirement goals, hopelessly out of reach?
That is such a paralyzing question.
Yeah.
And it fuels, I think, a huge amount of financial anxiety for people who are right in the middle of their careers.
Yeah.
The standard cultural narrative is just so powerful, isn't it?
Mm.
It says if you didn't start saving aggressively, like right out of college, you missed the absolute boat.
You missed it, and now you're forever playing catch-up against this impossible math problem.
Right. Exactly.
Absolutely. And that guilt, the guilt of lost time, that phantom compounding interest we hear about all the time, it can make people just completely freeze up. They do nothing.
Mm-hmm.
But today, we're doing a deep dive specifically to rip up that paralyzing narrative. We are looking into what is, I think, arguably the most pivotal decade for building financial momentum, your 40s.
It is such a complex time, though. On one hand, you're often hitting your peak earning years, which is a massive advantage.
A huge advantage.
But you're also juggling peak complexity. You've got high mortgages, you're potentially thinking about funding your children's college education, and you're often facing the reality of supporting aging parents.
All at once.
Yeah, all at once. And these competing demands can make the goal of saving for retirement just seem overwhelming.
So our mission in this deep dive is pretty simple. We want to extract a clear, motivating, and, mathematically supported roadmap for maximizing your savings and setting yourself up for financial freedom starting right now.
We're moving beyond the guilt.
Exactly. Beyond the guilt of the past and focusing entirely on the leverage you still have in the present.
And to do that, we've pulled key wisdom from some specialized financial planning guides that are designed specifically for the 40-plus demographic. We're talking about major firms like Fidelity, Nationwide, and American Century Investments.
So we have the established benchmarks.
We do. But just as importantly, we're also going to dissect the fascinating and sometimes pretty aggressive community debate we see in financial forums online.
Oh, yeah.
We're really going to tackle that core friction point. The difference between the traditional 15% retirement savings rate and the much, much more aggressive 25% catch-up rate.
And we need to explain in detail why that standard has shifted and why it's so imperative for the 40-plus investor to aim higher.
Understanding the math behind that required increase is, I think, the difference between feeling completely overwhelmed and feeling empowered.
Absolutely.
As one of the sources put it, 40 is a fabulous time to start or to accelerate your planning, but only if you adjust your strategy to the current reality.
Okay, let's unpack this and maybe provide some of that immediate psychological relief you mentioned. So many people in their 40s feel like they're late starters, but the source material is, it's overwhelmingly clear on this point.
It is.
It is absolutely never too late to start or intensify your investing strategy.
That really is the core message we see across the board. The 40s aren't just, an option for financial growth. They are explicitly defined as a pivotal decade.
A pivotal decade. I like that.
Yeah, and a prime time for financial growth. When you look at the factors that truly decide if it's too late to invest, your age is actually significantly less important than your current capacity to invest safely and effectively.
So we need to stop comparing ourselves to that mythical 22-year-old who diligently saved 10% of their salary from day one.
Exactly. That person might not even exist.
Right, and instead we need to leverage the strengths we possess right now in our 40s. So what are those strengths specifically?
Okay, so the first, and I think by far the most significant, is income.
Okay.
Individuals in their 40s are, statistically speaking, entering their prime earning years. Most people are settled in their careers. They've built up a lot of expertise, and they command much higher salaries than they did a decade or two ago.
And that gives you significantly more capital to put away.
So much more. It's the ultimate lever, really.
And that kind of busts another myth, doesn't it? That time always beats capital.
Not always. A dollar saved at 45 is, mathematically speaking, often a much larger and more powerful dollar than a dollar saved at 25.
How so?
Well, the 25-year-old definitely benefits from 2 extra decades of compounding time. We can't deny that. But the 45-year-old might be able to contribute, say, $2,000 a month consistently.
Right.
Compare that to maybe the $400 the younger investor could afford. That huge difference in contribution size. It allows for these larger, more impactful lump sums of capital right out of the gate.
So you're compensating for the lost time with just raw cash?
You are. It helps compensate for some of the time lost to compounding. I like to think of it as putting a jet engine on a slow-moving train.
I love that analogy. The high income acts as a powerful lever to just rapidly accelerate the accumulation phase.
Yeah.
Okay, that makes sense. What's the second advantage?
The second advantage is clarity and focus. By your 40s, you likely have a much clearer picture of your genuine financial goals, your priorities, your values. You've probably settled into a sustainable career path.
You're not jumping around anymore.
Exactly. You may have paid off some of those high-interest student loans or credit card debts, or maybe you've just realized that the flashy, debt-fueled life you thought you wanted in your 20s isn't the one you actually want now.
And that clarity is just priceless, especially when it comes to financial planning.
It allows for a much more purposeful, a more targeted approach to building wealth. You're less likely to make erratic investment decisions driven by, peer pressure or some short-term trend you see online.
Right.
Your strategy shifts from just maximizing youthful risk without a clear target to purposefully building wealth based on very defined goals.
So paying off the mortgage early or funding a specific retirement lifestyle.
Or achieving financial independence by 60, whatever it is, you're operating from a position of real experience.
Okay, and there was a third point, and this is the one I think people often miss because the anxiety is so focused on the start date.
Yes.
It's that your time horizon for compounding doesn't just end the day you stop working.
Exactly. This is so critical. When we talk about compound interest, we often assume the clock just stops the moment you retire, let's say at age 67.
Right, game over.
But our sources constantly remind us that retirement often lasts 20 or even 30 years. Your portfolio doesn't just turn into a pile of cash. It still needs to generate returns, protect your capital, and grow modestly just to keep pace with inflation over those decades.
So if I retire at 65 and I live to be 95, my money still has a 30-year time horizon in the market.
That's the critical distinction. Investing should be based on your full lifespan, not just your working career. So compounding is still working on your behalf for a very long time.
So that person who starts at 45, they still have 2 decades of peak contribution power.
And then another 20 to 30 years of compounding post-retirement. And this is why the strategy shifts. It's less about that aggressive, youthful risk-taking and more about finding a strong, purposeful balance between growth and capital protection.
You need to make sure your portfolio can weather those inevitable ups and downs without huge losses that you don't have time to recover from.
Precisely. The focus moves from purely accumulating capital to maintaining a steady, efficient compounding machine that can last you through your full lifespan. And that requires consistency, discipline, diversification, all factors that are far more potent when applied at a high-earning age.
Let's get to the mathematical heart of this, because this is where so much of the confusing advice for mid-career professionals comes from. Save 15%. No, save 25%.
It's everywhere.
It is. And when we dug into the sources and the community debates, the core difference between these two rates, it reveals a fundamental, irreversible shift in the financial reality for workers, not just in the U.S., but globally.
That's right.
So why is the old standard advice of 15% now often considered, mathematically insufficient for those trying to catch up?
Okay, so the 15% savings rate, which traditionally includes your pre-tax contributions plus any employer match, it really originated back in the 80s and 90s.
Okay.
And at that time, 15% was a perfectly sufficient target. But that's because the equation for retirement income was fundamentally different. There were 2 major secure components in place for most workers.
And those would be pensions and a stronger social safety net, right?
Yeah, precisely. Component 1 was employer-provided pensions, or defined benefit plans. A worker knew that after 30 years with the company, they get a fixed percentage of their final income, guaranteed by the employer for life.
A guarantee.
A guarantee.
Yeah.
Component 2 was the security and solvency of Social Security benefits. So that 15% savings rate. It was simply designed to fill the gap, assuming the pension and Social Security would do all the heavy lifting of income replacement.
But for the modern 40-year-old, that landscape is, it's almost unrecognizable.
It really is. As one source notes, most individuals in their 40s today do not have the security of an employer-provided pension. Companies largely eliminated them in favor of defined contribution plans, like the 401k.
Right. The risk shifted to the employee.
It shifted entirely. And on top of that, the future security and the payout levels of Social Security benefits are a very serious question, especially for those who still have 25 or more years until they can claim them.
So what you're saying is the entire burden of funding 20 to 30 years of life post-work has shifted almost entirely onto the individual's shoulders.
Yes. And that instantly makes the old 15% math incredibly challenging, if not completely impossible for many.
It's a harsh mathematical reality.
It is. We looked at some Fidelity research that provides some pretty sobering figures. The 15% assumption really requires you to start consistently in your 20s. If you start later, or if you have gaps in your savings history, the required savings rate just increases dramatically, almost exponentially.
Okay, give us the numbers. Let's see how steep that jump really is.
All right. If you begin saving at age 30 with nothing saved, the recommended savings rate jumps from 15% to about 18%. Not too bad.
Okay.
But listen to this acceleration. If you start at age 35, that rate leaps to 23%. And if you hit 40 with significant catch-up needed, you are now firmly in the 25% range, sometimes even higher, just to hit the moderate goal of replacing roughly 45% of your income from your own savings.
So the time you miss compounding has to be replaced with cold, hard cash contribution. There's no way around it.
There's no other way.
That's a huge burden. I mean, if you're 40 and sitting on little to no savings, 15% is just, it's completely inadequate to grow your nest egg fast enough. And that realization can be terrifying.
It can be. It means you'll either be forced to work much later than you want to, or you'll have to dramatically compromise your desired retirement lifestyle. This is why the difference between 15% and that more aggressive 20 to 25% becomes your essential catch-up contribution.
So let's talk about the argument for that 25% rate. Why is it becoming the new standard for mid-career investors? What does it actually do for you?
The argument for 25%, which is advocated by many forward-thinking financial groups, is that it provides one crucial thing: margin.
Margin? That's not a word you usually hear in financial planning. Margin for what?
Margin for life's imperfections. The 25% rate accounts for the statistical reality that most people haven't been perfectly consistent savers over the years.
Right. Life happens.
Life happens. It accounts for the fact that life will throw unforeseen bumps in the road at you, like a job loss, or unexpected health issues, or a market downturn right when you don't need it.
Okay.
And most importantly, it gives you the flexibility to pursue options. Things like retiring early, or funding a more robust lifestyle in retirement, or simply having the freedom to work less later in life. As one financial commentator we sourced noted, financial options are one of the most underrated luxuries in life.
I think that's a crucial insight. If you're saving 25% of your gross income, you are immediately training yourself to live on only 75% of your income.
Right.
And that changes the entire calculation for retirement.
It changes everything. Let's just look at the financial psychology for a second. If you are only saving 15% and you maintain the exact same lifestyle your whole working life, you would need your retirement savings to generate enough income to replace 85% of what you were earning.
That's a big number.
It is. But if you discipline yourself to save 25%, you now only need your savings to replace 75% of your pre-retirement gross pay.
And in reality, that 75% is often even lower because there are taxes you stop paying in retirement, right?
Correct. We should define that for the listener. When you're employed, a significant chunk of your paycheck goes to FICA taxes. That's the Federal Insurance Contributions Act, which covers Social Security and Medicare.
Okay.
Once you retire, you stop paying those taxes on your income. And on top of that, most people hope to have their mortgage paid off by retirement, which eliminates their single largest monthly expense.
So by saving 25%, you're already living below your means, which is powerful retirement insurance in and of itself.
It minimizes the size of the portfolio you ultimately need to sustain your desired lifestyle. So the 25% catch-up rate doesn't just grow the nest egg faster.
It also reduces the lifestyle target the nest egg needs to support.
Exactly. Yeah. It's a powerful 1-2 punch for the late starter.
Okay, so shifting from the contribution rate, let's talk about measurable progress. One of the biggest hurdles for our learner audience is just figuring out if they're truly on track without feeling completely overwhelmed by these huge, scary numbers.
Right.
We need clear, measurable targets. The salary multiplier roadmap.
The standard financial roadmap uses salary multipliers because they're proportional to your specific needs and your income level. The big long-term goal established by major firms is to have saved 10 times your final annual income by age 67.
10 times, okay.
To get there, your 40s have to be a period of rapid acceleration.
So give us the checkpoints for this decade. Where should the listener aim to be right now?
The consensus roadmap suggests a good guide is to have saved between 2 and 3 times your annual salary by age 40. That's your baseline.
Okay, 2x to 3x by 40.
And the trajectory from there should be aggressive. reflecting that higher savings rate we just talked about. You should be aiming for 4 times your salary by age 45, and then a significant jump to 6 times your salary by age 50.
Wait a second. Going from 2x at 40 to 6x at 50? That's a 300% increase in a single decade.
It is.
That highlights exactly why the 40s are the pivotal decade. How is that huge jump even possible?
It's only possible because of that confluence of factors we mentioned earlier, your peak earning years, and the compounding effect really starting to kick in on your base nest egg.
Right.
If you are diligent about hitting that 20 to 25% savings rate, you are adding 40% more capital to your portfolio each year than if you were only saving 15%.
Okay.
This huge inflow of capital from your high earnings compounds over the 20 to 25 years you have left, and that's what makes the 4x to 6x jump achievable.
And what if you don't? What if you fail to accelerate now?
Then the required savings rate in your 50s will become almost impossibly high. You might be forced to save 35 or even 40% of your income just to keep pace.
So hitting those multipliers isn't just, some arbitrary number. It's mathematical proof that you are successfully replacing the time leverage you missed with raw income leverage.
Exactly. It's quantifiable progress. But beyond just the total amount, we also need to talk about the actual mix of your investments.
Right. Asset allocation.
We're often told that as we age, we need to shift heavily from stocks to bonds. So how should the portfolio look for a typical 40-year-old?
Well, in your 40s, you still have a pretty robust time horizon, usually 20 to 25 years until your drawdown phase starts. So your portfolio should still lean heavily towards growth assets.
So lots of stocks.
Lots of stocks. The consensus allocation for an average risk tolerance at age 40 might be around 80% equities, that's stocks or stock funds, and 20% bonds or other conservative fixed income assets.
Why is that still so stock heavy when you're only, say, 25 years from retirement? Isn't that allocation potentially too risky given that you need to protect the capital you finally managed to accumulate?
That is the core conflict in mid-career investing, isn't it? The need for growth versus the need for protection.
It is.
The crucial factor is inflation. As one of our sources mentions, the cost of living can easily double over 20 to 25 years, even assuming a pretty average inflation rate of 3%.
So if your portfolio is too conservative,
It'll struggle just to keep pace with rising costs. You need equities because stocks have historically been the best hedge against inflation over long periods.
however, as you approach 50, the mindset does need to begin a subtle, intentional shift. The focus moves slightly from maximizing that upside growth to minimizing downside risk.
Okay, so what's the practical consequence of that subtle shift? What does that look like?
It's all about minimizing risk to protect the capital you've already accumulated. As you get closer to 50, you should start considering how to reduce the volatility in your portfolio.
So maybe moving toward a slightly less stock-heavy allocation.
Exactly. Maybe shifting towards 70% equities, 30% fixed income by the time you're 50. The goal is to ensure that if a major market downturn hits, like the dot-com crash or the 2008 financial crisis, your portfolio can weather the ups and downs without a massive 40 or 50% loss.
Because you simply have less time to recover from a steep market correction than you did in your 20s.
Right. Protecting your principal becomes paramount.
That concept connects directly to diversification, and specifically the advice we saw about including international exposure in your portfolio. Why is that global mix so important, especially when the U.S. market has been so strong for so long?
Well, investing solely in your own domestic market means you are completely exposed to the specific political, economic, and regulatory volatility of that single economy.
You're putting all your eggs in one basket.
A very big basket, but still one basket. Diversification, which means maintaining a broad mix of assets that includes international funds, serves as a strategic hedge against the American stock market.
I think we need an analogy here to make that really stick for the learner.
Okay, let's use a simple one. Think of your portfolio like a suitcase you're packing for a big trip abroad. If you only pack shorts and t-shirts, you'll be miserable if you hit an unexpected cold snap or a week of rain.
Okay, I'm with you.
International funds are like packing a jacket, gloves, and some rain gear. They protect you when your main gear, the domestic market, fails to perform.
That makes perfect sense. So you're investing internationally not necessarily because you expect guaranteed massive returns from it,
No, not at all.
but because you want to guarantee protection in the event that your home market suffers a prolonged downturn.
Exactly. As one investor noted in our source material, the only reason you invest internationally is so that if the domestic market ends up in a deep, lengthy downturn, what he called a 10th percentile standard deviation scenario, you're in a much better spot. because other global markets may not be correlated and might be performing well.
It's a sign of a mature, focused investor in their 40s.
It is. It's strategic hedging.
We've established that starting late means leveraging your higher income. But there's this fascinating mathematical tipping point that happens in your 40s, and it's based on the size of your nest egg.
Yes.
It shifts the primary focus of your financial strategy from simply adding money to managing the money that's already there.
This is such a critical concept. It moves the conversation from just saving discipline to sophisticated investment strategy. The source material makes a great distinction between a young investor and a mature investor.
Okay, and how do those two investors differ in terms of what levers they should be pulling to maximize their wealth?
For the young investor, let's say someone in their 20s or early 30s, the biggest, most dramatic impact on their future wealth comes from increasing their savings contribution rate.
Because their account balance is still small.
It's small, maybe $50,000. So the math relies overwhelmingly on fresh capital coming in the door every month. If they can double their contribution, they fundamentally change their entire outcome.
But once you hit your 40s and you have a growing nest egg, especially one that's past, say, the $250,000 or $500,000 mark, that whole dynamic flips.
It flips completely. The compounding on the money you already have starts to outweigh the importance of the new money you're adding.
So for the mature investor, particularly someone in their late 40s or early 50s with a sizable nest egg, what's the better move?
For them, increasing the rate of return or focusing on portfolio optimization gets them much more bang for the buck than trying to squeeze an extra $100 a month out of their budget.
Let's use the specific mathematical comparison we saw in the research, because this just completely flips the script on where you should focus your energy.
Okay, so imagine a hypothetical investor with a $1 million nest egg and 10 years until retirement. If that person managed to increase their annual savings contribution by $5,000, that extra capital, compounding at, say, a 7% rate, it only adds a small increment to the total over 10 years.
Right. It helps, but it's not a game changer.
Not at that scale. But if they could increase their investment return by just 1 percentage point, say, by reducing high management fees or optimizing their asset allocation, that 1% increase on the existing $1 million can add tens of thousands of dollars more over the same period.
Wow. So the 1% return increase on the existing capital can easily be twice as powerful as the extra savings contribution.
Or more. It's a fundamental shift in strategy. It means mid-career financial planning has to move beyond just automated saving and start demanding serious attention to the quality of your investments.
Your wealth building is accelerated not just by your peak salary, but by making sure every single dollar of that existing nest egg is invested as optimally as possible.
It absolutely is. And this is why working with a fee-only financial professional can become significantly more valuable in your 40s than it might have been in your 20s.
Yeah.
You need to shift from pure accumulation mode to strategic portfolio management mode.
Focusing on diversification, risk, and especially fees.
Intensely. That 1 or 2% improvement in your net return can be worth hundreds of thousands of dollars over the long haul.
Okay, so for many listeners in their 40s, there is this massive financial tension that probably creates sleepless nights.
I know exactly where you're going with this.
They are playing retirement catch-up at the exact same time they're starting to fund their children's college education. This is where emotion just butts heads with logic. Which goal wins?
This is one of the most common and emotionally fraught dilemmas in mid-career finance, and the source material provides a very clear and very tough consensus recommendation.
Which is?
Prioritize your retirement savings first. Absolutely.
I get the logic. You can't get loans for retirement, but for a parent, telling your child to take out debt for college can feel like a failure, can it?
It can.
How do the sources justify this hard line emotionally? I mean, the American dream often centers on giving your children a debt-free start in life.
It's justified by long-term responsibility, not short-term ease. The simple and brutal logic is this. You can take loans for college. There are student loans, parental loans, private loans.
Scholarships, grants.
Exactly. Your child can work part-time. There are numerous avenues for funding higher education. But you cannot, under any circumstance, take a loan for retirement. There is no such thing as a retirement loan to cover your living expenses when you're 75.
That puts a responsibility firmly on the parent to secure their own future first. Because if they fail to retire comfortably, they risk becoming a financial burden on those same children later in life.
Which is the exact opposite of securing their child's financial future.
Right.
The experts are unanimous. The greatest gift you can give your child is your own financial independence. The goal is to strive for a strategic balance, but you should never compromise hitting that aggressive retirement savings rate, that 20 to 25% we discussed, to solely fund college accounts.
So contribute to college, but only after you've secured your own aggressive retirement savings target. How does that balance work in practice?
The sources advise using tools like 529 college savings plans for their tax-advantaged growth. You contribute regularly, but you recognize that maxing out your retirement accounts, your 401k, your IRA, your HSA, that comes first.
And a key part of the strategy is just having an honest conversation.
It is. It requires maturity and frankness, but having that conversation with your children about realistic expectations is essential. Maybe they need to rely on alternative funding methods, like community college for 2 years, or attending a great state school that aligns with a more modest budget, rather than a top-tier private university.
It's a shared conversation about financial reality.
It has to be.
Okay, let's unpack all of this with practical application. Whether you're currently hitting the benchmarks or you realize you're playing serious catch-up, we are distilling this massive stack of financial guides into 5 concrete steps you can take today to build wealth in your 40s.
And these steps all focus on leveraging your peak income, protecting your future, and making the most of the tax advantages that are available to you right now, starting with the most destructive force acting against your wealth.
Tip number 1, eliminate the wealth drain.
This is paramount. The number one inhibitor to compounding is high-interest debt. You have to focus intensely on eliminating anything with a double-digit interest rate. We're talking credit cards, high-interest personal loans.
You have to be aggressive.
As aggressive as possible. If you are paying 20% interest on a credit card, you are generating a guaranteed negative 20% return on that money.
And when you compare that guaranteed loss to the market, which historically returns maybe 7 to 10% on average, that debt is essentially undoing all of your good work.
It's even worse than that. By paying off that 20% debt, you are achieving a guaranteed tax-free 20% return. You cannot legally get a guaranteed 20% return in the stock market.
That's a great way to frame it.
Every single dollar spent on high interest is a dollar that cannot compound for you. And it's likely growing faster than any investment return you could achieve. You need a clear debt reduction plan.
We often hear about the avalanche and snowball methods. For the learner, can you just quickly define those and say which one is mathematically superior for crushing that debt?
Absolutely. The debt avalanche method is the one that's mathematically superior.
Right.
You pay the minimum on all of your debts, except the one with the highest interest rate, and you funnel all your extra money there until it's gone. Then you repeat with the next highest interest rate.
Okay, and the snowball.
The debt snowball method is more focused on behavior. You pay the minimum on all debts except the one with the smallest balance, regardless of the interest rate. You pay that off first for a quick motivational win, and then you move to the next smallest.
So for the 40-year-old who's focused on maximizing leverage.
The avalanche method is the smarter choice. It minimizes the total interest you'll pay over time. Attack that high interest rate first.
Okay. Tip number 2. Maximize your tax advantage and use your catch-up.
This is where you leverage your peak income with government incentives. So immediately, you need to ensure you are contributing enough to get any available employer match.
It's free money.
It is, as one source notes, essentially free money, and it's the easiest guaranteed return you will ever get. Then, you need to utilize all available tax-advantaged accounts to their fullest extent. Your 401k, 403b, traditional or Roth IRA options.
And for those who are approaching the tail end of their 40s, there's a really serious financial tool on the horizon that needs some advanced planning.
Yes, the crucial catch-up contributions. Starting the calendar year you turn 50, the federal government allows for significantly extra contributions to retirement savings plans. This is explicitly designed for the late starter.
And what does that look like in real dollars?
In recent years, it has meant an extra $7,500 contribution over the standard limit for a 401k and an extra $1,000 for an IRA. Planning for that massive influx of tax-advantaged savings right now means you can accelerate your catch-up even more dramatically in your 50s.
We also saw a strong recommendation for the health savings account, or HSA. How does that fit into a wealth-building plan for this age group?
If you're eligible, which means you're enrolled in a high-deductible health plan, the HSA offers a unique triple tax advantage. It makes it arguably the best investment vehicle available in the U.S. today, not just a savings vehicle.
Okay, let's define that triple advantage clearly for the learner.
First, your contributions are made pre-tax, or they're tax deductible, which reduces your current taxable income.
Okay, that's one.
Second, the money grows tax deferred, just like in a 401k. And third, and this is the most powerful part, withdrawals are completely tax-free when used for qualified medical expenses, either now or in retirement.
So in retirement, you can treat it like a traditional IRA.
You can. You can take distributions for any purpose after age 65, and you'll just pay income tax on non-medical withdrawals. But because medical expenses increase so dramatically in retirement, maxing out your HSA is often viewed by financial experts as a primary wealth-building tool if you qualify.
Tip number 3, optimize your earnings. And crucially, keep the change.
Your 40s are statistically your period of peak earning potential. This is not the time to coast. This means actively seeking promotions, negotiating your annual raises, or even starting additional income streams like side gigs or freelance work if your time allows.
The math is just easier with a bigger income.
It is. If you're earning $200,000, saving 25% is $50,000 a year. Trying to save 25% of $80,000 is only $20,000. So you need to increase your denominator aggressively.
But the crucial second half of this tip is managing the behavioral side of money. Save your raises.
Absolutely. The enemy here is lifestyle inflation or lifestyle creep. That's where your spending increases just because your income does.
You get a $10,000 raise and you immediately upgrade the car or move to a bigger house.
You increase your monthly fixed costs. If you get a 5% raise and you let your monthly spending rise by 5%, you have gained zero financial advantage toward your retirement goal.
You have to be intentional.
Intentional saving of new income streams, a raise, a bonus, side income. That is the key to rapidly accelerating your wealth accumulation without compromising the lifestyle you're already comfortable with. You won't miss money you never started spending.
Okay. Tip number 4, shore up the safety net.
Financial stability prevents financial disaster. Before you aggressively pour every last dollar into volatile investments, you must build or strengthen your emergency fund.
And given the complexity of your 40s, mortgages, dependents, aging parents, the recommendation is pretty robust, right?
It is. Financial planners recommend aiming for 6 to 12 months of living expenses held in a liquid, easily accessible account, like a high-yield savings account.
6 to 12 months is a huge cushion, especially if your expenses are high. Why is that so necessary for the 40-year-old?
Because if life throws a curveball at you, a job loss, a major health crisis, an expensive home repair, you need that cushion to prevent the disaster of being forced to sell your investments at a loss during a market downturn just to cover the bills.
So that emergency fund is pure financial insurance.
It is. It prevents short-term chaos from derailing your 20-year plan and allows you to sleep at night knowing your family is protected.
And the final one, tip number 5, get your life documents in order.
Wealth creation is only half the battle. Wealth protection is the other half. And in your 40s, this means shoring up your insurance and your legal documents.
Okay, let's start with insurance.
First, review your life insurance. Do you have adequate coverage? Probably term life insurance to cover your income needs until retirement and protect your dependents. But more critically, do you have disability insurance?
The one everyone forgets.
Everyone forgets it. And it protects your most valuable asset, your income stream. The chance of becoming disabled before retirement is statistically much higher than the chance of passing away prematurely.
And the legal side, which also often gets deferred. What are the essentials beyond just a basic will?
You need an updated estate plan, and this involves more than just a will. You must confirm that you have correctly designated beneficiaries on all your financial and retirement accounts, your 401k, IRA, life insurance policies.
And why is that so important?
Because those designations trump whatever is written in your will. This avoids probate and ensures your money goes instantly to your intended recipient. You also need to designate powers of attorney for both your finances and your health care.
It's about planning for the unexpected.
As you accumulate more assets and your family structure becomes more complex, planning for the unexpected is one of the most loving and responsible things you can do for your family. It safeguards the wealth you are working so hard to build.
So this deep dive has shown us that the 40s are absolutely not a time for financial guilt over the past. It's a time for maximum leverage and intentional, mathematically sound action in the present.
By understanding the new mathematical reality that you likely need to aim for a 20 to 25% savings rate because of the decline of pensions and the pressure of a late start, you have the knowledge you need to change your trajectory dramatically.
If you prioritize crushing that high-interest debt, protect your peaking income with strong insurance, and focus on those salary multipliers,
you still have ample time to meet or even exceed your retirement goals.
So your goal right now is simple. Evaluate your current savings rate against that aggressive 25% target. And if you need to, use online calculators to find your specific catch-up number. Don't settle for the outdated 15% rule if you're truly trying to accelerate your wealth.
And here's where it gets really interesting, and this builds on our concept of margin. Our sources highlighted that one of the biggest non-investment risks in this age group is employment instability.
Right.
History shows us that many high-earning, white-collar workers are laid off in their 50s, and because of age discrimination or changing industry needs, they never achieve that same income level again.
So if that crucial peak earning window is shorter than you anticipate, if you only have 5 to 10 years left at your maximum earning potential, what immediate non-negotiable action can you take today to ensure that you are the one dictating your financial options when you reach that age, rather than having the choice of work or forced retirement made for you? Think about that margin and start building it today.